We are going to look at 3 stocks, HPQ, Meta, and H&R Block, and look at how we evaluate them using our 8 pillars and what we need to pay for them. So let's use our software. Again, if you're one of our 1,000 subscribers, please follow along. So HPQ, now remember guys, the ticker symbol is HPQ, the company is Hewlett Packard, HP. So the stock's currently at $35. The last year, we have a high of 41, a low of 26. Irrelevant when it comes to valuation. We're not trying to use the highs and lows of the year to determine valuation. We're using that as kind of an indication of, should we take a look at it or not? So we're looking here, first thing that pops up. Guys, I always want to reiterate this on dividends. A lot of people assume that the dividends a company pays are super safe. Not necessarily. Remember, these companies know that people love dividends. So they might borrow money or bleed out some cash they don't have necessarily coming in order to pay a dividend to attract more investors of stock and therefore pushing the stock price up. So your job as an astute investor who now knows is to look at the dividend, use our software, dividends paid, $982 million, and then compare it to the free cash flow. So our free cash flow on HPQ for the last 5 years has averaged $4.3 billion, and last year was $5.3. They can easily afford this $1 billion in dividends. I want it to be under 50%, and that's well under 50%. It's actually 20-some% in the 5-year and less than 20% in the 1 year. So that's awesome. So let's skip to the 8 pillars. Now, if you're new to this channel, I'm Paul. I'm a value investor. I use my 8-pillar process as a quantitative way to screen companies. What that means is I care about the numbers. Now, do I care about the company and how it is and all the qualitative aspects as well? Sure do. But what I care first and foremost about is the numbers. Do the numbers make sense? I start with my 10,000 stocks and I get the numbers to give me 200 or 300 that I like. And then I use qualitative aspects to pick 20 to 40 that I love based on the type of company they are, as well as the numbers making sense. So right here, HPQ, checks all the way around. Here's what I love. They're selling for 8.5 times earnings, 8.5 times free cash flow. Why is that? Well, I mean, they make printers. And a lot of people just think printers are going away, which very well could be the case. But that's going to make me go to my income statement and see what's going on here. And as you can see, 10 years ago, 115 billion, fell all the way to 28. That's 65 billion now. But look at this, guys. This is what's interesting. Since 2016, they've had yearly growth in revenue, basically. That's pretty impressive to me. Now I look at that and I want to understand where that's from. Could it be from acquisitions? Maybe. So let's go to the cash flow statement and we're going to scroll down a little bit and we're going to look at the acquisitions area. And there was one acquisition here that was sizable, $1 billion, 420 million, not bad, 134 and 700 million. So yeah, there were some acquisitions along the way, but how much did that add in revenue? I mean, they do every year 65 billion. Could it have added 10 billion? Maybe, but I doubt that. Usually acquisitions are multiple times higher than their sales that they're adding. So $1 billion acquisition might add 100 million, $200 million in revenue. So this looks like it's a lot of organic growth potentially, which is awesome. The other thing, look at this stock buyback. This is what I love. If you've watched our videos before, you know I love stock buybacks when the stock is cheap. This is a cheap stock. They're also saving on this dividend when they buy shares back. So I like what I'm seeing here. Guys, by the way, Berkshire Hathaway has taken a position in HPQ. I think they like exactly the things I like here. Look at this debt. 3 times free cash flow they can pay off their debt. All around great. So now what do? We look at these green checks and a lot of people out there might sit there and say, buy, buy, buy. No, no, no. What you want to do is use our stock analyzer tool. This is the most popular part of our site. We use the stock analyzer tool to make assumptions about the future because as we've all known, and if you've watched these videos before, every investment is the present value of all future cash flow, right? So we don't know the future. We have to make assumptions about the future. So I'm going to use the stock analyzer tool to make revenue growth assumptions, profit margin assumptions, free cash flow margin assumptions, and then also input my future PE and price to free cash flow. And it'll spit out a number for me at the end as to what I should pay for the stock. So let's begin with that. I'm going to do this for the next 2 companies as well. So please, by all means, rewind it if you need more explanation because it's a super important part of our software and our process. So I'm going to go to revenue growth. Now, in the last 5 years, they've grown 4% a year. I'm going to be conservative. I'm going to call it 0, 2, and 4%. Profit margin. I'm more focused on the last 5 years because 10 years ago they had 115 billion and they might have had some divisions they didn't like very much. So I'm going to focus on 6, 8, and 10. Let's say they crush it like they did last year. Free cash flow, 7, 8, and 9. PE, I'm going to go 8. I'm going to go 9, 12, and 15. 9, 12, and 15. Now, here's why I picked 9. Guys, it's a 0% growth company of my lowest assumptions. So they actually end up growing 0. I'm not going to pay a big premium for them. I need to make my money by getting a lower multiple and having them use that cash to either pay me out of dividends or buy back more shares. But if they do hit these 4% numbers, okay, it's a reputable company. It's well known. They build great computers. I'll pay 15 times profit and free cash flow for that. So that's where my thought process is there. I don't compare it to where the companies are right now. I'm assuming that the companies are mispriced right now. So my return. Now it's a big company. I'm actually gonna do something a little bit tricky here. I'm actually gonna do 12.5, 13.5, and 15% return from low, middle, and high. Now, the reason being is if I'm able to buy it for super cheap, 9 times multiples, I don't need as big a margin of safety. That already gives me ample margin of safety. So as I go higher in the multiple, I want a bigger margin of safety. I don't do that in every stock. It just depends on the situation I'm in. I hit the analyze button. Now remember, guys, $34.70 is the price. If it's all green, it doesn't mean go out there and buy the stock. It means verify these assumptions. Go do a little more research. What does that entail? Go Google, see what people are saying about it. Go see the pro and con, the bull and bear argument. Join our community. Thousands of people in here constantly talking about stocks. I guarantee people are talking about HPQ. Go read about Warren Buffett. Why does Warren Buffett like HPQ? Figure all these things out, but don't forget to look at the bear case. You have to understand that. Boom. Scroll down, guys. Low side, where it's at right now. High side, 60 to 70. Middle, it's around 50 bucks. Okay, so add it to your watch list if you want, or do more research now because it seems like it's a pretty good price based on these assumptions. Stock number 2, Facebook, Metaverse, Meta Universe. Let's go check it out. Meta platforms. So go back to the 8-pillar search, type in Meta. Boom. Now, guys, you guys know Meta. It's Facebook. Had a high of 384, a low of 154 in the last year. It got hit pretty hard here when their growth was slowing big time. Now, remember, my idea about Meta is that, yes, it's going to be hard for them to grow their users. Why? 3.5 billion people in this world use their products. There are 7.5 billion people in this world. How many of those 7.5 billion don't even have access to good technology and all these things? So there's still a lot more potential. My theory on Meta is they haven't maximized the revenue per user. So let's go check them out real quick. First off, no dividend here. I mean, it's a growing company. They're reinvesting themselves still. I'm not surprised to see a 0% dividend. Tech companies tend to not pay good dividends. Now look at this, 8 pillars, guys, all check marks. And the multiples are 19 and 20 times earnings and free cash flow. Very, very low debt. They can pay off their debt with less than 1 year of their 5-year free cash flow. This is pretty incredible stuff, all right? High return on invested capital. I'm glad they're starting to buy back their shares now. I wasn't so enthused when they were at $380 a share. And there were videos of us doing the stock when it was well above 320, 350, and I was not a fan of buying back shares. So let's use our stock analyzer tool again. We're gonna go right here, stock analyzer tool. So same thing as before. I'm gonna put my assumptions in. Now remember, the revenue growth of 40% a year is not gonna happen for the next 10 years. I'm actually gonna go very conservative here. So one thing that's great, guys, this is not hooked up yet, but look at this. We have analyst estimates here now. It's going to be able to show you what analysts believe the revenue will be for the next 5 or 10 years or whatever the number of years that we get access to. This is going to be very helpful for you to be guided along the way here. Remember, keep in mind that analysts aren't always the smartest people in the room. They have biases just like you do. So take it with a grain of salt. My personal opinion is for most analysts, I'm going to put their assumptions on the high side. So I'm going to sit here and do 5, 8, and 11% revenue growth. Profit margin. Now, profit margin, I'm probably going to keep a little bit higher, 28, 30, and 32, because I do think they're going to decrease their cash flow as they reinvest back in themselves and their profit. But for PE, I'm going to go 13, 15, and 17, because they still have a huge moat. They have WhatsApp, Instagram, Oculus, Facebook, all these. They touch so many people's lives in so many different ways. I think they have a very big moat that'll be hard to overcome. So finally, annual return, I'm gonna do 12.5%. The stock is currently at 180, trading a little lower today. Hit the analyze button. Okay, we have a low of 165, a high of 340, and a middle price of 235. So this is the best part, guys. If you bought at 380, you might be okay, but maybe if you believe these assumptions above and you want to own Meta, might not be a bad idea to pick up shares at some point to decrease your cost basis. But if you like Meta, maybe you sit there and go, hey, I'm going to put it at 165 here. Notify me when it hits there on my notification. It's going to bring to me on my phone, on the computer, and over email. It'll send me my message saying, Paul, Meta hit 164.95. Go check it out. Final company, H&R Block. Guys, full disclosure on H&R Block. I own H&R Block at $12 or $13 a share. Sold it at 25. Thought I hit a home run, and it's at $47 a share right now. So let's go. And my assumptions were certain assumptions on revenue growth, and I thought it was worth about $25 a share. So let's go look at the analysis after we look at the 8 pillars. 8 pillars. All 3 companies, 8 pillar thrillers. They've bought back 21% of their shares. When I owned it, it was selling for 3 to 5 times free cash flow and earnings. Now it's 14 and 13. Lower debt, not a ton. Free cash flow growth, revenue growth, net income growth. But I'm going to go actually check this out, specifically on the income statement. So going back 10 years, do you see this? It's kind of stagnant in this area right here. So the question you have to ask yourself is, why did it go from 2.9 to 4.7? Well, I think a big chunk of it was because of in 2020, that year between, there was a shutdown of being able to do taxes. So all that business came in this year. So don't be misled by that. Let's look at the net income line and look how different it is. 330, 250, 690, 410, 100, 1.3 billion. I think it's a little skewed here because even these two together is 650 average. They have very inconsistent profit, but they always have profit. Let's look at their cash flow. And look at their cash flow. Free cash flow, 1.85 last year. Previous years, -6, 800, 405, 604. So guys, the question you have to ask yourself when we do our stock analyzer tool, if you remember in our stock analyzer tool, we're doing everything, revenue growth numbers, all these assumptions based on last year's numbers. I don't think H&R Block, and they're probably guiding as to where this year's revenue will be. My guess is it's probably lower. Let's actually do a quick Google search so I can show you guys how I do this. H&R Block revenue guidance. So on May 10th, H&R Block increased its revenue forecast for the full 2022 year to 3.375 to 3.4 billion. So guys, look at that. Right there, it shows you that it's way less than what they did in the last 12 months here. We'll do the full annual level. So as you can see, 4.74 billion, they're already guiding for 3.4 to 3.5 billion dollars, way lower than before. So let's go to Stock Analyzer Tool. The hard part's going to be about Stock Analyzer Tool is it's very good based on starting from this year and going forward. So here's what I'm going to do. I'm going to assume -2% growth here. I'm going to assume -3, 0, and 3%. Profit margin, 13, 14, and 15. Free cash flow margin, big years. I'm going to do 10, 11, and 12. PE, I'm going to go with 8, 11, and 14. Same with the price of free cash flow. But I think I'm going to do for desired return, I'm going to do 17.5%. Actually, you know what? For the desired return on the low side, I'm actually going to call it 12.5. And for the other two, I'm going to call it 17.5. This is a little weird, but as you can see, look at my prices now. 20 to 25, 30 to 35, mid-20s. So it's probably pretty accurate that my mid-20s number was probably accurate. My guess is they're not going to be able to justify this high price going forward. If you like all these videos and you like what I'm talking about with the 8 pillars, subscribe to our channel and click our next video, which is about the 8 pillars and understanding our process better. Thank you very much for your time.